Hello, this is Professor Richard Holizak from Baruch College, here with another mini lesson on limit orders and market orders. This is a lecture in conjunction with my Financial Information Technologies course. You can find more information about that and many other topics on my website, holizak.com. So, what will we cover today? In this lecture, we're going to cover the limit order book. And before we get into that in depth, I highly recommend that you review my prior video on the limit order book. This will give you quite a bit more background about how the limit order book is constructed and how market orders and limit orders affect the book. For this video, what we'll focus on is a little more detail in the mechanics of limit orders, some of the advantages and disadvantages of limit orders, as well as the mechanics, advantages and disadvantages of market orders. And then I want to introduce a new topic, which is called marketable limit orders. So this is a lot of new vocabulary, I know, but we'll get into all of the details on this. So if you've not done so by now, go ahead and review the video on limit order book, and then you can jump back here and we can continue. Okay, so what you should have gotten from the prior video is for each financial instrument that's going to be traded, say, on an exchange, a limit order book will be created to hold the orders for the buyers and sellers. The orders are going to be arranged in the limit order book according to price. As we can see here, we have on the bid side orders descending in price. And then on the ask side, we can see that prices are sorted from lowest to highest. If there are two orders that are submitted at the exact same price, they are then sorted according to the time at which they were submitted. So for example, on the bid side here, we see that there are two orders submitted at 33.74, and we can see that order 108 came in after order 102, and this is why they are sorted in this way in the book. So again, this prior video talks about all of the mechanics of how the book gets built. So now we'd like to talk a little bit more in detail on limit orders. So limit orders are submitted by the trader by specifying the following information. First thing we need to know is the security symbol. That's going to be typically the stock ticker or the QSIP. We could also be trading things like listed options or futures contracts. Whatever the case is, whatever is going to be traded, we'll specify that with some type of a security symbol. The next information is going to be the direction of the order. That is, whether you're a buyer or a seller. Some systems call this the action, whether you are going to buy or sell. The next piece of information is going to be the limit price. That's the price at which you'd like to trade. Buy orders, that's going to be the bid price. That is the most you're willing to pay to buy. And for the sell orders, we're going to call that the ask price. That's sometimes also called the offer price. The fourth piece of information is the size, and that's going to be the number of shares or contracts or whatever quantity we're interested in buying or selling. And then finally, what most brokers will accept is some type of duration. How long is this limit order going to be good for? Many of them will include an acronym like GTC for good till canceled, and that means the order is going to remain good until the trader explicitly cancels it. Another typically used duration is a day order. That is, we put the order in, and at the end of the day, if it hasn't traded yet, it will be canceled automatically for us. So the trader is going to specify all of this information. They're going to submit that order to their broker, and then the broker is going to forward that on to the exchange. Now, there's a bunch of details that can happen here between the broker and the exchange. We're not going to get into those details in this video. That'll probably be in another video. But suffice it to say, there are many different alternatives that a broker has, including, of course, sending the order on to the exchange. So here's a typical broker order information system. This is an order management system from Interactive Brokers. It's given us a little bit of a price chart down here for the stock that we're interested in. It's given us the top of the market, the bid and ask, and the size that's available in the marketplace right now. And then at the top, it has this order entry bar. And so we can see here, we can specify the direction, whether we're buying or selling. We can specify the quantity. Here it's showing 500 shares. The type of the order is a limit order. okay, which is again why it's going to prompt us for the price. And so we're asked here, what is the most we're willing to pay? We're a buyer, and so we're asked, what is the most we're willing to pay? And then here is that duration. Okay, this order is going to be good for the day. So if I submit this order and it has not traded by the end of the day, Interactive Brokers will cancel my order. There are some advanced parameters here. Interactive Brokers has quite a bunch of different options that we can tag on to this order. Again, just for simplicity's sake for this discussion, we're going to ignore those. Hitting the submit button would go ahead and put that order into the market, just like we show on the prior slide. So one of the crucial points when working with limit orders is, what should the limit price be? There's a couple of things that are going to inform our decision here. The limit price really depends on how aggressive the trader is. For example, if the trader has determined that there's a particular price at which they can get into the market, and that's going to make sense in terms of their portfolio, in terms of the other holdings that they have, how much cash they have on hand, then we would say that this is sort of a passive approach. So, for example, maybe I look at my portfolio and I say, if I can get Intel stock for $33.70, that's going to make sense to me based on whatever financial model I've put together, whatever projections I have, or technical analysis. That may be my decision. And so I'm willing to put this order into the market here. Maybe buy 1,000 shares for $33.70, and I'm willing to let that order sit in the book. If the market happens to move down and I can buy for 33.70, that's great. That will make total sense in my portfolio. So that's a fairly passive stance that a trader might take. Someone who's more aggressive and more active may have a more immediate need to trade. And here the focus is going to be at the best bid and offer here at the top. And really what we're going to focus on here is the spread. And so if you recall from the prior video, the spread is the difference between the best bid and the best asking price. In this example I'm showing here, the best bid is $33.74. That's shared by two orders. And then the best asking price is $33.77. And so really the aggressiveness of the trader is going to point to the space or the spread between 33.74 and 33.77. Again, just as an example, an aggressive buy order is going to improve upon the best bid price. So for example, we may come in a little higher than the best bid price, $33.75, and that's going to improve upon the best bid. Notice in this example, we've only gone up by 1 penny over the current best bid price. So again, in that example, we're getting a little bit aggressive. Coming in at $33.76 would have been even more aggressive. An aggressive sell order would do a similar thing on the other side of the market, again, by improving on the best ask price. So what are some of the advantages of limit orders? First, if your order trades, you're guaranteed to trade at your price. And notice we've highlighted here the word if. We're going to get to that in a minute. So if you've put in a buy order at 33.75, and if your order trades, you are guaranteed to buy your shares at $33.75. So that's one nice thing about limit orders, is that we can control the price at which we trade. We can also set up multiple limit orders, even on both sides of the order book. For example, we can put in an order to buy and an order to sell at the same time. This is very similar to what a market maker might do. Again, we don't have time to get into the detail in this video, but we'll talk about market makers in a later video. We can also set up multiple limit orders on the same side of the order book, just at different price levels. So for example, we may be happy to receive some shares if we can buy them at 33.75, and we may also put an additional limit order in at 33.70. And so if the market's really falling quickly, both of our orders may be able to trade. We may be able to get the shares that we want at even lower prices. Now, what about the disadvantages of limit orders? Well, first of all, your order may never trade. We may put our order in at 33.75 and the market just continues to move up. The stock price just continues to go up. Other traders may outbid us and our order will just kind of languish on the book and we may never trade. And so this is a typical major disadvantage of limit orders. Another issue to consider is that your broker may encumber your potential position. And what does this mean? Well, suppose we put that order in to buy 1,000 shares at $33.70. Our broker may require us to set aside that $33,700 in our account. In the event that the market moves very, very quickly, we would need to make sure that our $33,000 is ready to go so that we have enough so we can buy the shares. Of course, this ignores things like trading fees and margin and so on, but we can imagine that our broker is very concerned in buying these shares for us that we have enough cash set aside. So we can't put limit orders into the book just ad hoc. We really need to keep track of where we're putting these orders in and how much money we have to set aside in order to keep our broker happy. This also is going to require continued attention in line with the level of aggressiveness. If I'm putting in a relatively passive order, like we've done here, maybe it doesn't require so much of my attention. But if we are putting limit orders right into the spread in a very active market, we're going to have to be paying very close attention to see when those orders trade, to see if those orders are getting outbid or if someone else is coming in at a lower asking price, for example, if we're a seller. So it is going to require quite a bit of our attention to manage the limit orders in the book. Also, we should also be clear about the broker's definition of GTC, good till canceled. There are some brokers that may automatically cancel all of our orders at the end of the day, regardless. But what does it mean if our order truly means good till canceled, good till we specifically or explicitly cancel, and the stock opens at a completely different price the next morning? Is our limit order still good? So I think that has the potential to be very risky. And so we need to be very clear about what we want to do, what the behavior we're interested in, as well as what our broker is going to do with our order if the order hasn't traded during the day and then when the market opens the next day, what's going to happen. Now let's talk a little bit about market orders. And again, if you've watched the other video, you know that market orders are submitted to the order book by specifying, again, the security symbol, that is, what is it we're looking to trade, the order direction, whether we're buying or selling, and then the size, the number of shares or contracts that we're interested in buying or selling. Notice there is no notion of the actual price. Market orders are executed immediately at the best price available in the book. And so a buy order will trade immediately against the ask side of the order book. A sell order will trade immediately against the bid side of the book. Again, we can think of a very simple path here. The trader specifies this information for their market order. They submit it to the broker. The broker submits that to an exchange, and immediately the order will trade with the order sitting on the book at the exchange. And again, I would just caution this is quite a bit simplified, and we'll talk about some other variations of this in a few minutes. Here again is our interactive brokers order management system. We have again a buy order. We want to buy 500 shares, and notice by specifying MKT for market, the price field goes away. So this order's intent is to immediately buy 500 shares at the best asking price in the market. Interactive Brokers does still include the day order, good till cancel, the duration here, and there's actually a special situation when that might occur, which I'll get to in a second. Again, clicking the submit button would immediately cause this order to be executed against the best asking price in the market. That would be, again, for a market buy order. So the main consideration that we need to pay attention to with market orders is their size. That is the number of shares or contracts that we're looking to buy or sell. The size of the market order is going to be set according to how aggressive we are as a trader. For example, if we're not very aggressive and we want to trade a quantity that's within the best bid and offer size, then we should be okay. This is not a very aggressive move. So what do we mean by, first of all, the BBO? That's going to be the best bid and offer, or best bid and ask if you want to call it that. And what we're looking at is the liquidity available, the number of shares available at these prices. And so what I would say here, I guess, is there's 800 shares available at 33.74 if we were willing to sell. And on the ask side, there are 400 shares people are willing to sell if we wanted to use a market order to buy. So again, a market buy order would look to take out some shares out of this best asking price. So here's a quick example. If we're looking to sell 100 shares at the market, we can see here that there's plenty of shares available to buy from us. And so again, this would not be seen as a typically aggressive move. There seems to be plenty of liquidity here, 800 shares. We could easily sell 100 there without really affecting the market much at all. What if what we're looking for is larger than the BBO size? So something larger than, say, 800 shares if we're looking to sell, or larger than 400 shares if we're looking to buy. So for example, suppose we want to sell 1,000 shares at the market. Now we have to be a little bit more careful. This is going to be a much more aggressive order. 1,000 share market sell order will immediately try and sell to all of these shares that are here in the book. So for example, we'll get a fill of 300 shares at 33.74. We would take out 500 shares at 33.74, and then we take out our remaining 200 shares that we're selling at 33.73. And so this is going to have a much bigger impact on the order book. And again, that's because we're trying to move or trying to sell a much larger size. So you can tell quite simply, the aggressiveness is really going to be based on the size of the order that we're trying to trade. So what are some of the advantages of market orders? Well, should be obvious. The order is executed immediately. There's a couple of caveats to that, provided sufficient liquidity exists. So I've just modified our order book here a little bit. If I'm looking to buy up to 400 shares at the market, I should have no problem doing that, the way the order book looks right now. However, what happens if the broker receives this instruction? What if I say I want to buy 1,000 shares at the market? Well, according to this order book, there aren't 1,000 shares up for sale. There's only 400 up for sale. And so the broker might say, okay, well, I can get you 400 shares at 33.77, but then I'm going to reject the other 600 shares. I might tell you we can't fill that order right now. So that might be one behavior. And what if there's no shares at all? What if another order just came and cleaned out the book? The broker may reject this, or the broker may sit back and wait until some liquidity returns to the book and then continue filling my order, filling my market order. So in some sense, this buying 1,000 shares at the market may sit around until it really is satisfied that it's purchased 1,000 shares. Here's another advantage though. There also might be a chance at price improvement. So if we submit a market buy order, we see here the price we're expecting is 33.77. However, the broker can do something interesting here. We submit our market buy order to a broker. And as we said before, typically the broker may forward that onto an exchange where it will interact with the order book. However, the broker may have some shares on hand that they're willing to sell. And in that case, the broker can do what we call internalization. they can internalize the order. Instead of sending my order down to an exchange, they can take the other side and trade with me. Now, they can do that so long as they improve upon the price. So, for example, the broker might say, well, I can take your market order and go to an exchange and probably get you 33.77. Or I can internalize it and maybe get you 33.76 or maybe 33.76.5 cents. Anything better, any price better than 33.77 is going to be good for me. And it's also good for the broker because, frankly, they don't have to incur the fees in going down to the exchange. So there is a chance at price improvement if our broker is able to internalize our order. What about the disadvantages of market orders? Here's where we really have to be careful. Timing is going to be a significant problem. And what do we mean by this? If another market order beats us, even by a millisecond, we may get an inferior price. So again, we'll look at buying here. Maybe we just want to buy 100 shares at the market. And when we look at our quote screen, we see that the asking price is 33.77. But just in the time it takes us to click the mouse button, another order comes in and takes out the 33.77. Maybe they buy 400 shares. In that case, my market order will hit the market and I'll get an inferior price. I'll get 33.78. I'll have to pay a little bit more. What else can happen? Limit orders could be canceled. So again, I may look at the market and say, okay, I want to buy 100 shares at 33.77. Maybe someone else beats me to the market and buys up those shares, but maybe whoever submitted these limit orders cancels them. And now look at the problem we have. By the time my order gets to the book, maybe I end up paying a much, much higher price. There's really not much I can do about this. I'm at the mercy of the market and however fast I can click my submit button on my order management system. And so this is a very real possibility. Either we could have other traders beating us to the market and getting these prices, or, which happens quite frequently, orders get canceled. Traders put an order into the market, they let it sit for a few seconds, and then they cancel it, they pull it out. And in that case, we may end up paying a much, much worse price. What else can happen? We can have this idea of market impact. If we have an aggressive market order, we can actually change the market price. We can actually move the market. For example, selling 200 shares at the market will not have much market impact. Even 300 or 400 shares, I would suggest, isn't going to do much to the market because there's some liquidity here at the best bid price. But what if I sold 1,000 shares like we saw before? Or what if I sold 2,000 shares? Now we're impacting the market. We're going to sell to all of these bid prices and actually push the market down. That will remove all of this liquidity and bring the bid price maybe down to 33.70. So we have to be careful with aggressive market orders because we can change the market price. There's a whole mini lecture we'll do on supply and demand and how that's implemented in limit order books. But this will give you a little bit of a taste. If we put some heavy demand there, that's going to change the price. So now I'd like to talk a little bit about what we call a marketable limit order. So a marketable limit order is going to take some of the advantages, the things that we like about limit orders, as well as some of the things that we like about market orders, and try and mitigate some of the risks that we have with the two of them. So here's how it's going to work. A marketable limit order is a limit order that is priced at or better than the current market price. And so what this means is a marketable limit order to buy will be priced at the best asking price or even better than the best asking price. A marketable limit order to sell will be priced at or below the best bid price. And what this is going to do is it will have the effect of a market order because it will match the price in the market. However, it will not continue on trading at prices that go beyond the limit order that we specify. This sounds pretty confusing, so let's just try a quick example. Suppose we're interested in buying 500 shares, and we believe that 33.77 is a good price. Instead of putting in a market order for 33.77 and maybe worrying about someone getting at this price ahead of us, we put in a limit order for 500 shares at 33.77. So notice our limit price actually matches the asking price that's in the book. This is what qualifies this as a marketable limit order. It's ready to trade immediately. Now, if no other orders are added or canceled or traded out of the book, here's what's going to happen. We'll immediately fill 400 shares at $33.77. But notice the next price down is 33.78, and that's going to be above our price, our limit price of 33.77. So while we'll fill that 400 shares at 33.77, that order goes out of the book, the remaining 100 shares will become a buy limit order at 33.77. Okay, let's back that up and we'll go through it again. So we want to buy 500 shares and we're specifying a marketable price of 33.77. So we'll immediately get a fill 400 shares at 33.77. This will remove that order from the book, and the new best asking price is now moved up to 33.78. But we wanted 500 shares. What happens to the remaining 100 shares? The remaining 100 shares turns into a limit order. Well, it was a limit order, but it rests in the book at 33.77. So notice when buying with a marketable limit order, we do have the potential to trade at a price that we are interested in, that's good for our portfolio. But at the same time, if someone beats us to the market, our order can simply rest in the book at whatever our bid price was initially. So that's an example of buying 500 shares where the limit price was marketable, that matched the asking price. Let's do another example. We'll reset our book here back to our original prices. And let's go ahead and sell 1,000 shares. And again, we're going to put a marketable limit price here of 33.73. So now because we're selling, we're looking at the bid side. And we can see here that our limit sell price, 33.73, is better than the bid price that's up here. So here's what's going to happen. We will immediately fill 800 shares. That is the 300 here for order 102 and the 500 from order 108. We'll immediately fill those at 33.74. So those orders will be out of the book. What will remain is 200 shares at 33.73, and that was from order 109. Because we were able to completely fill this order, there's nothing left of this new limit order in the book. We've gotten our complete fill. Notice we've gotten a little bit of price improvement, 33.74, and we've also finished up our order at our limit price of 33.73. So we've affected the book, but we've still been protected in case someone else had sold just ahead of us. All right, so I think that'll do it for this tutorial for now. In summary, we've talked about the mechanics, the advantages and disadvantages of limit orders and market orders, and we've introduced maybe a new idea to you, which is that of a marketable limit order. And hopefully this will help you with your trading. And again, we have much more information on my website, holozak.com, in the category of financial IT.